SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi Austrian Central Bank workshop on how to raise R star. It's now time to turn to the final session on long-term trends, structural policies, and R star, future scenarios and policy implications. We start out with our keynote speaker, Charles Goodhart from the LSE and SUERF Fellow. Charles, the floor is yours.
Thank you very much, Ernest. It's a great pleasure to be here. The main thesis of our recent book that I've written jointly with Manoj Pradhan was that inflation and nominal interest rates will rise. Now, whether real interest rates and the equilibrium real rate R star will rise or stay low and negative is far less certain and depends on a variety of factors. I'd like to add here that if inflation does rise, nominal interest rates will rise with it, and that will give the central bank more space, so that the actual underlying question is whether inflationary pressures are likely to rise or whether they are going to be predicated to remain very low. And that actually is the key question, rather than the question or the other issues involved. So next slide, please. I'd like to actually start by talking about why we expect both inflation and nominal interest rates to rise, because I think that that actually is the key question, rather than what's likely to happen to real interest rates. But I will then go on to record why I expect real interest rates to stay low and negative over the next couple of years. Indeed, they might even go down a bit. And then I shall end by listing the factors that in the medium and longer term could either lead to a continuation of low and negative real interest rates or to higher real rates. Now, the people, most of you who are listening in, don't realize what an extraordinary period we've been living in over the last 60 or 70 years. If you go back from, say, about 1960, over the previous 2, 3, 4 centuries, nominal interest rates, inflationary expectations, and real interest rates actually remained relatively stable throughout all this period, going up a bit during wars, particularly if you lost them and had to go off the gold standard, but otherwise remaining fairly stable, with inflation running very low at about 0 to 1, nominal interest rates at about 4%, and real interest rates somewhere around 3%. Then from about 1960 onwards, till Paul Volcker managed to check this trend until the end of the 1970s and the beginning of the 1980s, inflation, inflationary expectations, and nominal interest rates shot up. I'll talk about real interest rates in a moment. And then from the 1980s onwards, inflation, inflationary expectations, and nominal interest rates declined very, very sharply, as has been pointed out recently, to the lowest ever, and real rates have been declining with them. Now, why did this happen? Well, prior to about 1960, the 1960s, effectively, monetary policy and interest rates were related to external controls, i.e. maintaining the value of the currency in terms of an outside object of value. Gold or silver during the period in which we had gold or silver standards, and then in Bretton Woods to the dollar, and the dollar in turn was related to gold. And then for a variety of reasons, which you all know, Bretton Woods broke down, the US under Nixon abandoned gold, and instead of being related to an external object of value, the interest rate in monetary policy became determined by internal demand management considerations. In the 60s and 70s, demand management was in the hands of policymakers who had been brought up during the Great Deflation. And to them, unemployment was the overriding evil, and their attempt was to maintain unemployment as low as they possibly could. And if inflation started to rise, they tried to check it by direct controls, wage and price controls, which didn't work. And then, of course, it began to get into the system. We had stagflation, and Paul Volcker managed to turn this round. Now, why have we had this massive decline since then? Well, and a lot of people say that it was because of better monetary policy, and to an extent, monetary policy with central bank independence and inflation targets was a great deal better. But actually, it didn't take the monetary authorities wasn't all that difficult for them to do this. They didn't have to raise interest rates against political or other opposition. Interest rates were declining throughout, and central bankers were best friends of ministers of finance. So there must have been some other underlying major disinflationary forces operating during this period. And the thesis in our book with Manoj Pradhan is that this effectively was a huge, indeed unequaled ever, massive, great labor supply, positive supply shock. On the left-hand side, the blue line shows the number of those of working age population available in advanced economies. The yellow line shows the number available in China and Eastern Europe. And since China is the most populous country in the world, it was much bigger than the available labor supply in the advanced economies. So, and China and Eastern Europe have low wage economies compared to the high wage economies in the West. So anybody who could shift their production of manufacturers and increasingly of services from high to low wage economies suddenly found just an enormous increase in the availability of labor. The dashed line is Africa, and what is going to happen to Africa over future decades is a key issue, which is of enormous importance. The annual rate of change is on the right-hand side, and you can see how it went up leaps and bounds over this particular period and then went down. Now, it was not just the working age population, it was participation in the working age population. Because when I was young, alas, back in the 1940s and 1950s, most women stayed at home doing housework. Now, for a variety of reasons, including the decline in the fertility rate, the availability of consumer durables, washing machines, refrigerators, etc., 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 the participation of half the population, i.e. the women, moved from doing housework, which wasn't included in GDP, to actually becoming part of the working age population, working in ways that added to GDP. So you've got this just enormous shift upwards in the participation rate of women. Governor Holtzman described the need to raise participation rates. They've been raising enormously over past decades, and now inevitably I think they're going to flatten out to a degree. Now, what that has meant has been that over the last 30 or so years, the combination of globalization, the arrival of China and Eastern Europe, the improvement in the working age population because of the baby boomers, the increased participation of women, the availability of workers has more than doubled in 30 years. There's never been anything like it. The only equivalent went the other way when there was the Black Death in Europe, cutting the labor supply by something like a third or so within a few years. This has been the biggest positive labor supply shock that anyone will ever see, and it is now ending, and it is now about to reverse. Not only is the working age population going down, participation of women leveling out, but globalization is now in slight decline, and the dependency ratio rating the number of old to workers is going to rise very sharply. And the older expensive, not because we eat more or buy more clothes, or we do go on holiday a bit more, but because we get sick, particularly diseases, mental diseases, dementia, Parkinson's, which medicine can't cure. So care and Medicare, medicinal needs are increasing hand over fist. Next slide, please. So that what we're going to have is increasing present policies, public sector deficits and public sector debt ratios as far as the eye can see. And the COVID was simply a small pimple boom on top of an underlying expected rate of increase in deficits and debt. And admittedly, the deficit and debt in the US, this is the CBO figure, is not as high yet quite as the peak in World War II. But wars, thank God, are temporary, and after wars are over, there is a return normally to prudent fiscal policies and the debt, and indeed some repression and some inflation, and the debt ratios go down. On present policies, you can look at the OBR, you can look at the CBO, debt ratios are going to go up as far as the eye can see. So what's the outcome of that? So how are we going to deal with our debt problems, including not only the debt of the public sector, but the debt of the private sector, with private sector debt ratios around the world of non-financial corporations rising very sharply? The nicest way to deal with debt is through higher growth, but that is extremely unlikely. Actually, aggregate growth figures are likely to go down because the rate of growth is a function of the rate of growth of the available workforce, together with the productivity that they can bring to bear, and the rate of growth of the available workforce is going to go down. We are all moving in the direction of Japan. Some of us, like in Germany and much of Central Europe, is going to be moving in that way, respect very sharply. Productivity per worker is likely to go up, in part to offset the effect of unit labor costs on the increasing shortage of labor. And we think that that will need to add to more investment at home, because much of the investment has been offshored recently to support the shift of production to the low-wage economies. Now, the better way to deal with all of this is through taxation, which is, I think, the right solution of various kinds, but it's extraordinarily difficult to introduce taxation. For example, the carbon tax, which virtually all economists favor. You only got to think about what happened to the Gilets jaunes. There are ways of trying to improve tax rates, but they will be difficult. Monetary activism will be highly problematical as long as the debt ratios remain so high, because the elasticity of response of debt interest to interest rates, now that debt ratios are so high, it has just risen dramatically. And therefore, if central banks start raising interest rates, they'll start running immediately against the interests of ministers of finance. And moreover, if you start raising interest rates, the effect on asset prices and the effect on fragile private sector firms could be so severe as to lead to a further potentially very strong recession, and that would do nobody any good. Raising interest rates, raising taxation, or reducing the benefits to the old, or raising the retirement age, which Governor Holtzman described, are all politically extremely difficult. And Putin, President Putin of Russia, who has got greater control over Russia and what goes on in Russia than almost any other person in authority. The one thing that he found so difficult that he almost had to cut back at it was trying to raise the retirement age. You try it. Politically, it ain't going to be easy. So raising retirement ages, raising taxation, reducing benefits to the old, raising interest rates and all that require a positive political statement which is politically unattractive. Whereas allowing inflation to rise doesn't require any words, doesn't require any act. And indeed, the politicians can go on saying how much they dislike it and how much in future they will insist that it be cut back. But they don't actually have to do anything, which is why we think that under the present debt trap position that Claudia was talking about, inflation, though unattractive, will be necessary up to a point until the political disadvantages of inflation become so severe that you have to take the other politically unattractive measures. What we need is more political optimization studies rather than economic optimization studies. So why didn't it happen in Japan? Because that's always driven that point that's made to us. Now, you will note that in this diagram, which shows the public sector debt, the interest rates, and the debt service ratios, I haven't put in which country is which. And the point of doing this, is that I want to show that what has happened in Japan is actually not particularly unique. Japan is part of the larger world system, and what is happening in the world, particularly with world availability of labor and so on, is common to all our countries. For those that are actually interested, Japan is the top right. You can hardly see in this, but in the vertical axis, you'll see the top right, that Japan goes up to 250, which is more than the public sector debt ratio. Now, Hiroshi didn't speak almost at all about the rest of the world. Everything he talked about was Japan, Japan, Japan. But Japan is a part of the larger world economy, and the Japanese corporate sector was not sluggish. Faced with China abroad and with cheap labor supply available, Japan Inc. invested enormously, huge outflows of external investment abroad, a much greater production abroad. Much of the profits of Japanese corporations came from abroad and were reinvested abroad. There was a huge shift in Japan, as elsewhere, out of manufacturing into services, out of relatively well-paid manufacturing jobs into relatively low-paid part-time service jobs, which inevitably reduced the rate of inflation considerably. Again, there is this argument that Japan did everything it possibly could to raise inflation, particularly with monetary policy. But if you look at the broad money supply, actually broad money supply never rose above 5% during these particular years. All the QE was focused on raising bank reserves rather than the broad money supply. And it is arguable that had a different form of QE been undertaken, buying different kinds of assets, you might have had a somewhat different effect. And very recently, the Japanese money supply has risen to double the level that it's had in recent years. And of course, the availability of available cheap labor and all of that in China for outsourcing all the manufacturing elsewhere is going to be considerably less, as the Chinese demographic conditions are reversing remarkably sharply, and Chinese inflation and the availability of cheap imports from China is likely to turn around quite sharply. So let us now turn from the consideration of inflation and nominal rates separately to thinking about their interrelationships, the real rate of interest. Actually, you ought to distinguish between ex ante, that is expected real rates, and ex post outcome real rates. And ex ante real rates are somewhat less variable as forecasts, especially of inflation, can be systematically wrong and have been and frequently are. In particular, in the 1970s, when ex post real rates were extremely low, ex ante real rates were not nearly as low, because expectations were not that we were going to have the massive inflation we got towards the middle and end of the 1970s. And after Paul Volcker turned inflation round, the generality of workers and companies didn't believe that he would be that successful. And the very high ex post real rates that we got in the early 1980s were not matched by ex ante real rates. The concept of real rates is a nebulous concept and needs to be dealt with very, very carefully, if only because ex ante and ex post are really quite different. This is just to say, don't put all that weight on expectations. Expectations are frequently systematically wrong during periods in which inflation is going up, because expectations are much more based on what has happened in the past. We are all myopic. We tend to extrapolate what has happened in the past into the future. There's an underestimate of inflation during upwards movements, an overestimate of inflation during downwards movements, and you get that sort of pattern. And expectations are much more, at any rate, longer term expectations are much more closely related to what has happened during the past equivalent period than they are to the future equivalent period. So all this stuff about well-anchored expectations, it ain't going to do you any good. So real rates in the short run, they're going to remain highly negative. The policy commitment is that no central bank is going to raise nominal interest rates in the near-term future, and inflation is likely to be systematically underestimated, as it has been over the last year, and is likely to remain so over the next couple of years, so that real interest rates are likely to remain extremely low and negative for the next 2 or 3 years. Meanwhile, debt ratios, the debt trap is very much in existence, and interest rates have a much larger negative effect on output and less on inflation when firms are financially fragile, because firms have got to do everything they can in order to remain in being and avoid insolvency. And now longer term considerations for R star. Factors perpetuating low, maybe negative R star. Low growth. It's a fairly standard argument that low growth makes for low real interest rates. If growth is very low, then you expect that your incomes will be lower in future. So to equalize life cycle, you've got to save more now. If the growth is very low, then investment projects are less likely to be attractive. But there's a great question of how to measure growth. After all, if you measure growth in aggregate terms, we're going to get low growth, probably lower than we've got now. But if you measure growth in terms of output per worker, growth is actually likely to increase, as it had in Japan. Growth per head, growth per worker, or growth per hour has been growing faster in Japan than in almost any other advanced economy. And that is likely to be true in our economies. We've got, at the moment, a great momentum and continuation of very weak labor. Trade unions have collapsed, declined in power. Labor force power, with the shift from manufacturing to services, has been reduced very sharply. And that is likely to continue, which is one of the, at any rate for a time, until we get strong labor shortages and labor power will go up. There's a very interesting article by Auclair and a lot of colleagues, just in the CEPR and NBER, arguing that there's going to be continuation of desired wealth to income ratios, and that is going to keep interest rates low. And if debt ratios remain very high, that will make it very difficult for central banks to raise nominal interest rates very much. And then again, there may be lower benefits for the old, higher retirement ages, and so on, again, which Governor Holtzman mentioned. On the other hand, there are quite a number of factors leading to rising real interest rates. If inflation continues as we expect, debt ratios will go down to a point at which a new Paul Volcker can start bringing inflation down again sharply. Climate change will, in the short run, I think, raise investment demand and other costs much more, even though it will have huge benefits in the medium to longer term. Again, with higher nominal interest rates and with higher unit labor costs as a shortage of labor, there will be less inequality. and lower corporate profitability. The arguments in the very interesting paper by Mian, Straub, and Sufi about inequality raising savings is absolutely right. And we think that the future will hold less inequality, could jolly hardly hold more. Housing. As the population gets older, older people don't like moving houses for obvious reasons. There's going to be a misallocation of floor space, and therefore the decline or the decline in working age population will have less effect on reducing the demand for housing than you might think. Too much concern about investment is about non-corporate investment. Much more attention needs to be given to housing investment. There's a rising age of marriage and having children. That will reduce the number of years without children that you focus on your retirement and the great saving ages, so that the age and the decades in which you're saving more are likely to be reduced. Less globalization, which I talked about. There's going to be much more investment at home than there has been in the past, because you can't invest in China or Hungary. The global pandemic, I think, showed one of the importance of having crucial production at home rather than abroad. And then again, there's the other considerations, political dislike of inflation and so on, which I've been talking about. Now, the argument of the view of Manoj Pradhan and myself is that the positive effects on rising real interest rates will somewhat outweigh the negative effects on lower real interest rates, but it's a very much more finely balanced argument than whether inflation and nominal interest rates will rise, about which we're much more confident. Now, will real rates rise, or will they fall or remain very low in future? What's the balance between factors raising interest rates and factors lowering interest rates? You will find out. At my age, I shall be 85 next month, I probably will not be around to do so. So best of luck to you, and particularly to central banks, who are going to find a much more difficult decades over the next 3 decades than they had over the last 3 decades. The last 3 decades were the glory years for central banks. The next 3 decades are going to be much, much, much more difficult. For all central bankers, best of luck to you. That's it.
Thank you very much, Charles, particularly for the good wishes, which we very much appreciate, and we will do our best to cope also with the challenges in the future. We're now going into 3 topics in more detail: the impact of climate change or protection, the impact of digitalization, and the impact of globalization or deglobalization or reglobalization on our star. Cornelia Holthausen from the ECB and Javier Perez from the Banco de Espana are going to enlighten us on these topics. Cornelia, the floor is yours.
Thank you very much, Ernest, and thank you also to Charles Goodhart for this very interesting presentation, and thanks to the organizers for putting this fascinating topic on the agenda. So let me start by saying that the presentation is my own and does not necessarily reflect the views of my institution. So also I draw here a lot of the material that was produced by the ECB strategy review. Actually, there were work streams on climate, on digitalization, and on globalization, so that fits very well into this conference. So the focus of this presentation is the following. Well, I'll be happy to talk about the effects of a number of these topical themes on our star, so climate change, digitalization, and globalization. And if time allows, I will also briefly touch upon the effects of COVID, given that they actually touch upon those same structural factors in various ways. The key messages to start up front: the drivers that I've just outlined, these are major structural factors that have the potential to impact on the natural rate of interest. The size and also the sign of the impact, however, is really uncertain, because there are many interactions at play and that are very complex, and also any policy prescriptions have to be handled with care. Of course, these climate change, digitalization, and globalization are not the only major structural factors that are impacting on R. There are others such as demographics or distribution effects, which I will not further dwell upon, and of course also the pandemic may have an impact. So this is the diagram that I will use to illustrate the effects of these three different aspects that I will be talking about. So first, on the right-hand side, the first relates to the productive capacity or potential growth that stems from the contributions to potential output, thereby productivity, labor, and capital. And then the second is on the left-hand side related to excess savings, which are a function of preferences on savings and the ratio of dis-savers to savers, and also the demand for safe assets, which depends on uncertainty and risk aversion. So let's start with climate change and also the protection against climate change. And here we have to distinguish between transitional factors, that is regulatory policies, and factors that are related to physical risk. So if you think of transition risk, there will likely be a host of new regulations. In Europe, for instance, we have the Fit for 55 package that the European Commission just recently published as a proposal, but there will be other regulations. So this creates uncertainty. Markets will have to start adapting. Firms will have to invest to comply with the new rules and regulations and to adapt to new energy pricing. So if we look at the very short term, this might divert resources from other productive inputs while not yet increasing a value added. And new regulations might also raise entry costs or deter firm entry, which could have negative impacts on competition and productivity. So both of these very short-term effects would be negative for us. But if you look more at the medium term as regards transition risk, and Charles has already said it, there's will be new investment in green technology, and that could give a boost to productivity and potential, and thus R star. So it's positive for R star, and this is what I would expect to be the prevailing factor. There's the Porter hypothesis that says that if transition policies are credible, innovation will be encouraged, benefiting productivity growth in the long run. But for this to happen, it's important that the investment also translates into an addition to the capital stock. So there's net investment. Transition to more carbon neutral technologies means both that parts of the capital stock will be depleted through stranded assets, and then also that new one is built up. So it's the net effect that will matter, which we hope all will be positive. But especially in the short term, the positive effect on productivity and labor supply is likely to be offset, as firms might have to reallocate resources. So short term, potentially negative for R star, longer term, positive. Of course, there's also physical risk. So what if the transitional policies are not able to provide a climate, to avoid a change in the climate? And of course, one physical risk is that there are disasters that destroy capital stock, so R star negative effect. And another effect is that an increase of temperatures around the world, and particular temperatures that may go above the comfort temperature of humans, which is apparently around 18 to 22 degrees Celsius, that this could have an effect on labor productivity. So there are studies that show that extreme temperatures above or below this range can have physiological effects on mortality, health, and also labor supply and productivity. And some evidence quantifies this and finds that labor productivity decreases by 2% above comfort, per degree above comfort temperature. And so this would push R star down. And of course, uncertainty also plays a big effect. No one knows at this stage to what extent and how physical risk will affect us. And there's also uncertainty about the transition policies. How forceful will they be? Which sectors and which regions will they affect? And this uncertainty could encourage households to raise precautionary savings and may induce firms to postpone investment. And this could put downward pressure on market interest rates and also R star. So therefore, the path of R star will also depend on the credibility of policies. Then finally, on safe assets, again, this increased uncertainty about firms' asset values and public finances in the transition to a carbon neutral economy may boost the demand for safe assets. And as a result, the premia that market participants are willing to pay for holding safe assets are likely to rise. And this again puts downward pressure on the natural rate. And given in particular that there's no pan-European safe asset or not much of it, there may be also asymmetric effects in the euro area. And more generally, effects of climate change on the determinants of R star may really differ across jurisdictions in terms of both magnitude and timing. And if we think of monetary policy, this opens up more complex scenarios, also making it potentially more difficult for the central bank to achieve its goal. So bottom line, overall, one might say that the climate change might impact many of the drivers of the natural rate in ways that are difficult to really assess and reconcile. There are a few channels by which climate change could raise R. There are several others that would also tend to suggest that it's unlikely to be a major factor supporting R star. So this illustrates how important the agenda on climate change is also from the perspective of R star. Public policies could support innovation that needs to take place in the private sector. There could be public investment, and the recovery and resilience plans that are currently being adopted are an important factor here because they contain a very large green element. But importantly, policies should also ensure that labor and capital markets function smoothly and thereby enable a good transition to new technologies. Public policies should also act forcefully in order to reduce uncertainty both about transition and to avoid that physical risks affect us all. And finally, these policies should be credible. And I think one important aspect of here is that a global strategy would be very welcome. So let's go to digitalization. So here there are lots of channels operating through productivity and which tend to indeed increase R star. There can be new forms of output, new ways of doing business. So together, what you may refer to as product and process innovations. And there may be new types of digital assets, for example, those relating to data or data science. And these are all boosting productivity and potential growth and thereby supporting R star. And the same holds for the greater resilience of digital supply chains, for instance, and the greater degree of online or virtual competition that may result from it. So new types of digital assets also can have the effect of generating higher demand for capital and notably intangibles, also raising R star. So the bottom line here really is that the potential effect on R star could be large, even though we all know that productivity gains over the digital age have so far been limited, so R star has not been impacted much. But and also here I'd like to stress that the recovery and resilience funds, which do have a large digital component, goes in the right direction. Now finally, let me go to globalization. So also for this here, there are mechanisms at play that can enhance productivity and raise potential and R star. So one mechanism relates to the greater competition across borders that's entailed by greater globalization, the integration of markets, and is raising productivity and potential. And related to this, you could see the greater learning by doing that may result from firms engaging in exporting activities and as a result of the greater exposure and contact to other suppliers. And globalization may also be considered to offer greater variety, greater quality of inputs, again contributing. And the same as a greater market size, which could lead to a more efficient allocation of resources across borders. But on the other hand, given the benefits from and the strive for globalization, any major uncertainties or risks that are related to cross-border trade in goods or services may provoke an increased demand for assets and lower R star. So therefore, such uncertainties and risks could be detrimental. Now, this is mostly theory in support of globalization leading to a higher natural rate, but of course, what we observed was that the increase in globalization over the past decades went actually hand in hand with the decline of R star around the world. And there are a number of theories that explain that. So the decline could be related to factors other than globalization, but simply reflect similar conditions across countries. Financial integration could have played a role as the world becomes more integrated. The pool of savings that demands safe assets as a store of value could multiply with a more or less constant supply of safe assets. And finally, there's the theory of trade openness. There are theories that in the early phase of globalization, increased trade integration may have accentuated competition among companies, reducing firms' market power, bolstering productivity. And this could have rather posed upward pressures on the natural rate. But as globalization matured, the opposite mechanism could have played out, with the rise in market power that's putting more downward pressure on the natural rate. So from that, a policy conclusion could be to enact policies that go against the winner takes it all situation and by countering market power at a global level. So maybe something like the global corporate interest rate discussions taking place at the G20 level could be a step in the right direction. So I wanted to say also something about COVID, but I think time runs a bit out. So the recovery and resilience funds may have an impact on both the digital and green aspects. So therefore we are positive, as I just described. But of course, at the same time, we will all have learned to use more digital technologies, teleworking, which could imply a greater labor market flexibility, and more use of digital technologies could boost our star. But at the same time, as Charles Goodhart has already mentioned, also globalization could decline as a result of COVID. So, so we have to see what plays out here. Yeah, let me conclude here. Thank you.
Thank you very much, Cornelia. I hand over to Javier.
Okay, thanks so much, Ernst, for the invitation, of the opportunity. So let me just put a chart that has popped up in several of the previous presentations that I wanted to put to signal like two issues. No, the first issue is that this global reduction in real interest rate, R-star or whatever, is global. This we have already seen, but it's global in the sense that it's affecting advanced economies, also emerging economies. I put here Brazil. So basically, let's say countries are like moving in that direction. When you aggregate, and this is the right-hand side chart, we see that there was this increase in real rates. These are 17 mainly advanced economies, an increase, and then this reduction that also Claudio was mentioning directly as such since the, let's say, mid-80s, 90s, and so on. So the issue is that given that this is we see like a global phenomena now, so this is kind of globally generalized across countries. So which is the genuine role of what we call globalization? So I'm going to be very specific about one part of globalization, but I wanted also to mention some of the factors that the literature has that have popped up and that at the end of the day have a global dimension. I mean, on demographics, Professor Goodhart and Governor Holtzman were touching upon. Inequality also has some bearing from globalization. Bear in mind that so there was a huge reduction at the global level in inequality, so across countries, and we've seen that over the past 2-3 decades. But there was an increase also perceived within advanced economies, in particular on inequality, where you have this wealth going into the more wealthy, which are the people that have a lower propensity to save. So in that sense, I mean, you get this scarcity effect, and that also Cornelia was touching upon. But at the same time, I mean, we have other local, really global trends. I mean, that this trend to see lower government investment. That sometimes, I mean, is in European debates. This was also mentioned before, but it's global in the sense that maybe, I mean, and there are some discussion on that. Basically, governments are increasingly providing more insurance to citizens, also in this context of globalization, so that you get into this social dominance hypothesis, whereby governments channel resources in part linked to the fact that we're in this globalized world, and then citizens within countries in this also the context of increasing inequality need more insurance. But of course, I mean, there are some effects which are, let's say, more closely linked to what to these common trends, but that we call like globalization, in particular those linked to financial globalization. So it has to do with the channeling of savings and the supply and demand of safe assets, but in general savings across countries. And of course, I mean the reduction of global risk or not in the world, and more specifically, maybe it's something that more people also identify globalization, which is trade globalization. So we will be focusing on these two aspects: financial globalization, trade globalization, and of course some of the issues, I mean, will be touched upon, in particular those linked to productivity by other speakers next. So I will be focusing on specific issues. No? So in particular, what we learn in the literature is that we have like from financial globalization, we have this a more financially integrated world, as I was mentioning before. There's this pool of savings that demand, in particular, safe assets. The supply of safe assets is more scarce, and this has an impact on interest rate, given that these two quantities, let's say, don't grow or have not been moving at the same speed. And in particular, the increasing participation of emerging market economies in the global economy. Let's say, just look at the share of the global economy in the hands, let's say, of emerging markets, including China. I don't know, 30 years ago, and look at it now, and the striking differences, I mean, can give you an idea. No? So let's say we have more financially integrated markets. We have this pushing effect from emerging markets, and we have this increase for the preference for this facet and this scarcity effect. There is a lot of empirical evidence that actually, I mean, validates some of these aspects, looking at it in different dimensions. Then the second aspect of globalization that has to do more with the trade openness. So economies trading goods and services more and more, and localization and delocalization of industries, increase in integration, in trade integration through global value chains, and so on. That basically, when you look at the debate, which is less clear cut when it comes to empirics, as we will see in 30 seconds. Has basically like two lines of reasoning. The first one is, of course, I mean, as also Cornelia was mentioning before, more interconnection has a lot of influence on competition across countries, then within countries, in sorting out firms which are more productive, less productive, more open. So this, at the end of the day, pushes productivity. At the same time, in particular in the early phases of globalization, in this explosion, let's go back to the 90s to start with. In particular, you have this reduction in market power of certain firms in industries. So at the end of the day, this would push up this productivity and then in interest rate. At the same time, this growing share of emerging market having this growing share in the global economy comes also accompanied by this increase, let's say, economic stability or better institutions in this emerging market world that makes it easier, I mean, to consolidate these gains. And this also has a translation in these global safety nets and so on and so forth. There's a different force now that is maybe more recent. It has received a huge attention from the literature. That is the fact that as globalization matures, this induces a lot of market power in several, let's say, superstars, firms that win, and then this would put this downward pressure. So these dwelling factors, when it comes to empirics, are not that clear cut. What we know, let's say, from the empirical literature, I was mentioning before, we have some papers that find this negative relationship between the accumulation of reserves in emerging economies and long-run interest rates. This is one of the arguments I was mentioning before, and this positive relationship between the supply of safe assets and global rates, which is a complement of that. While the relationship between trade globalization, this increased openness, and the long-run interest rate is more ambiguous when it comes to empirics. And so let me draw in my last a few minutes on one particular piece of evidence or model I was mentioning before, the references, in which that allows us to allows me to organize a bit all these factors, and then I will try to draw some lessons for the future, no? And that from this broader reflection. So the first thing, given that trade openness, as I was mentioning before, this trade globalization has this ambiguous theoretical effect. So if you go to this table, I put like the major, let's say, competing factors, demographics, the risk at the global level, and then the two related to globalization. This financial integration, called global savings, and trade integration, this trade openness. From a theoretical point of view, I was mentioning before, and this has been mentioned before, these are quite clear-cut, with the exception of trade openness. So that's why, let's say, to tackle this in the framework of this network in some models, then basically in an empirical model that follows the standards, first all these traditional variables were incorporated, and the standard results, empirical results, as one would expect, were allowed. And then the inclusion of trade openness in empirical terms in this context turned out to be positive. This means that, let's say, these forces pushing productivity over time compared to these forces more related to this, let's say, superstar effect, tend to be net out, but on the positive side. Let me just show you one chart, and if I may focus your attention just on the last 20 years, this is illustrated. So this is an illustration from this empirical work, in which you see that demography or demographical factors, let's say these blue bars are pushing down these real interest rates in deviations. These are like contributions. Also the decrease in risk. This global savings, also Cornelia was talking about this mismatch, no, between the safe assets demand and supply. While in net terms, or even in contributions, when you look at the dynamics of the bars, trade openness has had, let's say, a positive influence on that due to these effects. Of course, I mean, depending on what you think or what you have in mind for the future, and then I'll try to draw some lessons, let's say, from this analysis and where the current debate is. Then you could see that these forces can either keep on pushing what we see from this empirical analysis and this theoretical prediction, or can kind of turn in different dimensions, in different directions. And in particular, I mean, what happens in the future has to do a lot with what we perceive or see within this debate of, as I was mentioning before, whether globalization will continue, whether we're in deglobalization, where there is a reglobalization. And just let me give you like 2 or 3 hints. The first one is that, let's say, these trends that we see now around, let's say, more or less openness of economies, or integration of economies through global value change, in reality precede, I mean, what we've seen in this pandemic crisis. Even though, of course, I mean, some of these dynamics, I mean, have been accentuated, and in particular, one thing that we've seen accentuated is that the vulnerability that sometimes in global value change pose for countries that depend too much on them. This is a good factor. Actually, the literature is clear, saying that typically firms that relied more on global value change, even though whenever you have a big problem, that you have a big shock at the beginning, but in the recovery phase, I mean, if you are more diversified, really, I mean, you are going to do better than let's say, other firms, countries that depend on a specific, let's say, jurisdictions, I mean, to produce. So, looking forward, and allow me to give you a couple of hints that focusing on what has not been said yet. On financial globalization, a lot have been mentioned. Here, really, the key channel looking at the trends had to do with what will happen, or what is going to happen whenever we see that emerging markets economies, the key ones, are in a more mature phase of their, let's say, long-term cycle, if you allow me to call it that. So this will affect this demand for safe assets, and whether there will be new or not new sources of supply of safe assets, like in the European debate. I mean, we have all this, let's say, common debt issuance linked to next generation, and even and maybe, I mean, in the future something else. No. And on the trade globalization debate, also Professor Goodhart was hinting before, that maybe we'll see some backlash as discussed before. But what we really see now in the data is more like some trends in regionalization. So let's say more European Union, more Asia integration, more on the Americas, rather than a pure, genuine, let's say, a closure of economies. This is one thing. And the last thing is that at the same time, we also see that the geopolitics are again, starting to play a renewed role. No? And in this case, just to give you an example of the debates in Europe, we have all these debates on this strategic autonomy, whereby, let's say, the European authorities, what are looking at is, okay, which are really the vulnerabilities that European firms are exposed to, given their huge integration in global value chains, and then is there something that can be done in that dimension? This is one thing, let's say, integration. And the second thing is that, of course, exposure or vulnerability when you're not a producer of certain raw materials that are needed for this digital transformations, for this climate change transformation, so that you need really to make sure that you get the proper stock, let's say. And of course, exposure in terms of energy, gas. We have all these debates, no? So it could be the case, and I will kind of conclude with that these geopolitics are going to play a role in this in deglobalization, even though, let's say, from the efficiency point of view, and even from the resilience point of view, the literature is not so clear on that. And actually, I would say that maybe we'll learn that more diversified firms or countries in general are more resilient to this type of very big shocks, like a pandemic.
Thank you, Javier. We turn immediately to Gilbert.
So what I'm going to present is a work from different researchers in the Banque de France and with Philippe Aguillon and other economists, and I will try to give an abstract of that. So next slide. So as everybody knows, we observed for several decades a slowdown on productivity. Here it's represented for the US, and except a short decade from 1995 to 2005, we observe this decrease, and now productivity growth is at the lowest level observed for more than a century in the US. Next slide shows that it's a general observation in all developed countries here, US, Euro area, UK, Japan, but I could have put more countries. Productivity growth is at the lowest, except of course war period. Next slide. When we observe a so general, universal productivity slowdown, the question is, of course, is there some common factors to explain this general productivity slowdown? And what we try is, in different papers, is to give an explanation of that. And the explanation is that this productivity slowdown could come, at least for a part, but a large part, something as 1/3, from a decrease in financial constraints. And in fact, the story is very simple. It was already given before. Decrease in financial constraints, and for instance, but not only, decrease in real interest rates allows inefficient incumbent firms to remain on the market and discourage new performant firms from entering the market, and from that we get a less cleansing mechanism and a misallocation of factors. And more globally, our story is that we could suffer from an anthropogenic circular relationship. Less financial constraints makes less productivity growth, and less growth, of course, makes less decline of real interest rates and of financial constraints. So next slide, the decrease in real interest rate, as we know, is general. It was already mentioned by Claudio before. Here, what I represent is real interest rate, real long-term interest rate in 17 countries. So you have the median, the first quartile and the third quartile, and you see that this decrease from the 90s is universal. Next slide. When we look at the message from the literature, we see that the literature on the individual data is really contrasted. Some papers find a favorable impact of more financial constraint on productivity growth. And this favorable impact comes from cleansing mechanisms that I've already mentioned. Another literature, the type of literature, finds a detrimental impact as more financial constraint and higher interest rate makes it more complex and difficult to finance investment, R&D, innovation, and so on. So from that, we get a decline of productivity growth from more financial constraint. So next slide. Of course, some papers, and I think we are one of the rare papers, estimate there's two mechanisms on the same data set. That's what we've done with Philippe Aguian, Antonin Bergeau, Rémi Leca, and Magan myself on a very large data set of French firms. And on this data set, we get exactly the two mechanisms. We estimate exactly these two mechanisms, a positive impact and a negative impact from here, a lower financial constraint. And we use for that a very specific natural experiment, which is what was happening at the end of 2011. It was a very unanticipated announcement from the ECB of an enlargement of credit quotation to be eligible for refinancing operations. And from this natural experiment, we have managed to estimate the two channels I've presented before. So next slide. The question is, of course, now if we have these two channels, which one of these two channels dominates currently at the country level, at the macro level? And it seems to be the first one, which means that more financial constraints would have a positive impact on productivity growth, as it is shown in numerous papers. I quote here some of these papers, but there is a lot of others, and Claudio is one author of this literature. But there is an abundant literature showing that in the current period, the first channel would dominate. And in fact, you know, a relation between financial constraints and productivity growth could be represented by this type of inverted U curve here, which is on this slide. At the beginning, you know, when financial constraints increase, the first mechanism dominates. The second one, it means that cleansing mechanisms dominate the other one, financing R&D, financing innovation, and so on. So it means that we benefit from an increase of productivity growth, and from a certain point, we would suffer from the other mechanisms. It means that the second mechanism dominates, and it means that the fact that it would be more expensive for firms to finance R&D, innovation, and so on, would dominate the fact that we would get more cleansing effect. And we would observe the negative impact of financial constraint on productivity growth. And we estimate, this inverted U curve on French data, and at the global level, at the country level, we would be at the left part of this graph. Next slide. And we can see also this from the fact, for instance, and it was shown also by the OECD, but that's what we observe on French film. We observe a growing gap, a growing distance between the productivity level of firms which are at the frontier, productivity frontier, and productivity level in average of firms which are laggard to this productivity frontier. And of course, this growing distance comes from the fact that we would have less cleansing mechanisms from more accommodant financial conditions for firms. Next slide, which would be the last one. What to expect from the COVID crisis concerning this relation? Here again, we get two opposite mechanisms. First one is, of course, decline of financial constraints from more expensive monetary policy and from larger fiscal support to firms. And this would contribute negatively to productivity growth. But in the same time, in the context of the COVID crisis, we observe a dramatic acceleration of the digitalization. So we don't know which one of these two mechanisms will dominate in the medium term, of course. But just to conclude, of course, in the exit strategies for state and for central banks, there is two extreme risks to avoid. First one is not to support enough by very accommodative policies performant firms, which would have a negative impact on productivity growth. And the opposite risk is to support too long unperformant firms by very accommodant policies, which would continue to contribute to low productivity growth. And we are exactly in the current period in this situation to try to avoid these two extreme risk concerning exit strategies. Thanks a lot.
Thank you very much, Gilbert. I think this is a very important conclusion. This leads us to the last speaker of our session and of today's workshop, Luiz de Mello, who will take a forward-looking perspective, how to raise productivity post-COVID. Luiz, the floor is yours.
Thank you very much, Ernest, and thanks. Congratulations for this fantastic morning. Let me go straight to 2 points that I would like to focus on, which tie in well with, I think, what Cornelia, Javier, and Gilbert mentioned a moment ago, and several points that Charles mentioned in his keynote. But 2 points that I wanted to highlight are basically that there are several pre-pandemic structural weaknesses that have held productivity growth back over the last few decades. As Gilbert mentioned the chart a minute ago about labor productivity, I'll show you on TFP in a minute. And the other point is the issue that is more related to the pandemic and the challenge that it adds in terms of making sure that the short-term preservation measures that have been taken over the last 18 months or so are consistent with longer-term productivity enhancing reallocation. I don't think I needed to spend too much time persuading you of the reallocation elements in the pandemic that we're still facing, and given the asymmetries across sectors and occupations, and the crisis is representing. So I'll focus on that aspect. Okay, this is a chart. I mean, Gilbert showed numbers for labor productivity. I just wanted to show TFP to complement that picture, which is pretty much consistent with this gradual decline. Two large economic areas there, the Euro area and the United States. And you see that in addition to the usual demographic factors that affect potential output, you can see there that the green segments of the bars relating to TFP are also a big part of the story about this gradual decline in the ability of our economies to grow in a sustainable manner. So this is basically to illustrate that point about pre-existing challenges before the pandemic hit us. And then a thought or two about how the COVID pandemic can affect potential output. And then you can see it essentially through potential labor, both quantity, immigration disruptions being one of them, but also the quality. There's a lot of literature on already on how the effect on schooling, for instance, can affect potential labor in the future. Scarring effects, especially for those groups with the weakest attachment to the labor force, and so on. Potential capital being one of them. Uncertainty regarding the duration of the crisis, the strength of the recovery, and how it affects investment. And a positive that was also mentioned by previous speakers, investment has been carried out in digital technologies, for instance, as a way of firms coping with the pandemic. But I wanted just to focus on potential TFP and one aspect of it. You know, there is a lot that can be said about within firm productivity drivers, issues related to experimentation, but also negatives related to managerial time being diverted to other activities, and so on. But there is one aspect in potential TFP that I think is particularly interesting, which is resource reallocation. We have there a between sector story, shifts of capital and labor between sectors, but there is a lot that is happening also and is likely to happen within sectors, between firms and within sectors. One of them being related to market dynamism that Gilbert mentioned before. You know, all this ability of basically facilitating entry and exit being a key element as we get out, move out of the pandemic and economies started to recover, and the potential obviously for reallocation that can enhance productivity moving forward. To bear in mind, the reallocation is an important channel of productivity growth. About 20% of jobs are reallocated each year through firm entry and exit on average in OECD countries. Resources, typically move towards weaker, lower productivity firms towards more productivity firms. That's what drives productivity growth in the end. And obviously thinking of all the negatives, all the costs associated with job destruction. So reallocation needs to enhance productivity to be useful. Otherwise, we're going to basically have those costs dominating. And I'm stressing this, which is 2 points I wanted to make about the policies that have been put in place during the pandemic. Policies related essentially to preservation. If you look at the labor side, a lot that has been done has to do with different types of job retention schemes, and the chart shows you the extent of those programs in this cross section of the countries, the actual use of the programs that were put in place, in the hope that then preserving labor firm relations, avoiding those costs of job destruction that I mentioned in the previous slide, would be a way of maintaining productivity potential moving forward. But 2 things to bear in mind. This is work that colleagues have done for Australia, looking at their particular job retention scheme. And the objective here is to highlight the fact that preservation is not without consequences for productivity enhancing reallocation. Gilbert mentioned this in his presentation as well. If you look at the case of Australia, the three panels there show you that, but if you look at the left-hand side panel only for all firms, what happened when the program was put in place is that it did what it was meant to do. It basically stopped separations. It froze the economy as it was, but it had the undesirable effect of also reducing hires. So immediately you had this potential for reallocation that was reduced drastically with the introduction of that support scheme. So the implication of that is the following, and that ties in, I think, with what was said before as well, is that if you look at the gap in employment growth between high and low productivity firms, what we see is that when those support programs are put in place, basically you have that flat segment of the line that basically it was freezing that type of reallocation. You know, both low productivity and high productivity firms, employment was growing at the same speed for the duration of the program. But as soon as as you can see towards the right-hand side of the chart, we see that process of reallocation starting again. You see the gap in employment growth growing in favor of higher productivity firms. And that's what we want. We want to make sure that preservation is followed by productivity enhancing reallocation. And that's the very important aspect of what to expect post-pandemic. We had the same look at, for instance, loan or credit guarantee schemes that were also provided by countries. You can see basically take-up rates and the size of the programs that were potentially put in place. And you see basically the same type of message that employment growth has been higher, as far as we can measure it, in those situations where you have a lower size of credit guarantee schemes relative to the total size of the economy than in situations where you have a lot of it. So first consideration for labor, second consideration for capital and the survival of firms, that point in the direction that moving forward as economies start to recover, one important point for policy is make sure that we restore this productivity enhancing reallocation potential in our economies. And to conclude is to tie all that back in with the considerations about pre-pandemic, pre-existing challenges for productivity. And here there are several aspects of it that we need to be dealt with. Issues related to the lower diffusion of innovation, of productivity from lagging firms to the frontier. You'll see here the mirror image for the OECD countries of the chart that Gilbert mentioned or showed for France. Issues related to slowing market dynamism with declining firm entry and exit that we've been observing for a while. Issues related to concentration and rising markups in product markets, declining job mobility. So different aspects of our economies that are contributing to, or structural factors, if you want, that are contributing to this productivity slowdown. Needless to say, some of these factors are related to policy, some of them are related to the mix of technological factors and other factors that have been highlighted today. So the point I wanted to make here is that there is a lot of scope, obviously, for policy to mitigate some of these structural trends that we've been looking at. But we also see at the same time that there has been some loss of impetus in pro-growth reform in OECD countries. What this chart shows you is that both for advanced economies and for emerging market economies, the responsiveness, that's one metric that you can use to measure the impetus of structural reform. This is the responsiveness to OECD recommendations based on our Going for Growth benchmarking exercise. And you can see through over several vintages of this exercise that there is an increase in impetus in periods of crisis. If you look at the immediate aftermath of the global financial crisis, you see those peaks in the chart. We are looking the chart basically focuses on the pre-pandemic period. It will be very interesting to see how much the pandemic will contribute to this, to rekindling this impetus of pro-growth structural reform moving forward, because we know that that will be needed to at least address some of these challenges that that all of us in the course of the morning have mentioned. And I'll stop here, and thanks again, Ernest, for the invite.
Thank you, Luiz. This concludes our workshop. I think the workshop did manage to bring together major lines of arguments to explain possible drivers of R* historically and also going forward. The workshop has, however, also exposed the limits of our understanding of these drivers: globalization, digitalization, climate change, demography, savings and investment relations, and the role of policies, structural, fiscal, and monetary, will all play a role, but the net effect is far from certain. There may also be circular and mutually reinforcing relationships between the economy and policy at play. I take along from Luiz' intervention that COVID has probably just exposed pre-existing structural weaknesses, but not really is the cause itself. I tend to take along also that R* is not likely to rise by itself, that decisive policy action is needed to achieve this, and that such policies will not be easy to implement politically and for other reasons. But they are nevertheless highly necessary. What are the implications for central banks and monetary policy? Well, I think for me, one implication is to act with caution and to aim for robust policies by not pursuing narrow paradigms or targets. Let me thank all speakers and moderators for your extremely thought-provoking presentations. I thank you all for speaking, for attending, for your interest and for your time. And I hope to see you soon again. Bye-bye. Take care.
Bye.
Bye. Bye-bye. Bye.
Bye-bye.